Hey, today I want to talk about the capital assets pricing model. So basically, if we know any security beta, we can calculate the required return of that security, given the market return and the risk-free rate. So here the market is basically is the benchmark. Let's say if you use stock, the stock in the U.S. stock market is no matter is part of the S&P 500 or not part of the S&P 500. So if they can use the S&P 500 as a benchmark, so the S&P return that will be the market return. Then the risk-free rate you can use T-bills, T-note, or T-bonds. So basically, it's a government bonds that consider risk-free. So then you also can not just for individual stocks, you can use it for ETFs, mutual funds. Let's just say if you want to calculate mutual funds return, so you can use the beta. So basically, let's say mutual funds they benchmarking S&P 500. So I have a S&P 500 return minus the risk-free rate. Then you times the beta, then plus the risk-free rate. So this will give you the required return of the mutual funds, which means that given all the information, so the mutual funds should give me this much return. If the return is lower than this, maybe you should not invest in the mutual funds. Anyway, so before I to the next slide, I just want to say make sure because you use beta here. Beta is calculated use the covariance of the individual stock with the market. So you have to have a correlation in order to use beta. So which means you have the R squares have to be greater than 70 in order to use beta. Then in order to use this CAPM. Okay, so basically, if you look at this this equation, you can see this is a linear equation. The return, the security return, is the y. Is here is the y. Then the beta is the x. This is security beta, right? So given this equation, you can draw a line. This is a linear line. So when beta equal to 0, this one is, you can say if beta equal to 0, you can get the return, the security return just equal to the risk-free rate. Yeah, well, it makes sense. Say if the security there's no risk in it, so I just then you can just give me the the risk-free rate, the government bonds or government T-bills. So that's fine. So when the beta is equal to 1, so basically your security is 100% coordinated with the market. So your return will be the market return. So you can see the equation. If beta equal to 1, so this one is risk-free rate can cancel out. So your required rate of return just equal to the market rate. So another interesting observation. So there's a trainer. This is called trainer ratio. So basically, it's the portfolio rate minus risk-free rate divided by beta. So this kind of is just is equal to the slope. Given the fact if it's required rate of the return. So anyway, so if they're outperforming, so this one probably is higher. So anyway, so it's an observation. So here is a real example. This is a mutual funds. You can buy these mutual funds at many broker dealer like Charles Schwab, TD Ameritrade. So these mutual funds, they give you information here. The benchmark of this mutual funds is S&P 500. The beta is 1.25. Alpha is 0.8. Then R square is 85.53. So here I just want, so first R square is greater than 70. So yes, we can use the beta to evaluate the return, right? So also you can see they give you alpha here. So I have a formula here for alpha. Alpha is equal to so basically the real return of the portfolio minus the required rate of return. This is a CAPM. This is a CAPM. Basically, it's a real return. The difference between the real return and the CAPM required rate of return. So this portfolio show you have a 0.3, 0.8. So it's positive alpha is good. Make sure this information they give to you, they say it's 3 years as December 31st, 2020. So basically you can just use this to evaluate 3 years return. However, I'm just oversimplify. I just use the beta to evaluate the 1 year, 3 year, and 5 year. Really, if you want to do 1 year, 5 year, you should find out the 1 year and the 5 year beta. This is because this is a 3 year beta. So anyway, that's just some information, but I assume the beta is the same. Let's look at the 1 year. So they give you benchmark return. So basically say, these funds showing is outperforming the benchmark. 1 year is have higher return, 3 year have higher return, 5 year, 10 year. But if these funds every day is up and down, it's very 1 day 5% return, the next day is 7% down, then the next day 5% up. So up and down is a lot. But S&P relatively smooth. The everyday one, go up, go down a lot. So so the risk you in these funds is different from S&P. So that's why we need to use this CAPM to find out. We adjust the risk given the beta, right? Given the beta is 1.25. You have to see the benchmark beta is 1. So you have a 1.25 beta, which means you are more risky. So given the beta, we can calculate the 1 year required return. So basically, I'm using 1.5% of the 10-year bonds rate as a risk-free rate. So the required return is 1.5% risk-free rate plus 77.8% is the benchmark, the market return minus the risk-free rate times the beta. So we'll give you the required rate of return. You compare this return to the the real return of these funds. This is very good. So given all the information, so this one tell you this one is really outperforming the benchmark. So you get alpha alpha is 21.1%. Wow, that's a very, very impressive. So this year one, we assume the beta is the same. If you really want to find out, you should use the real beta of the 1 year, maybe a little higher than 1.5. So anyway, so that's just I'm simplifying here. For the 3 year, for the 3 year, we can find that the required rate of return is 19.3, is less than the 20%, less than the 20%. Okay, so you can see it's a little bit, higher. The real return is just a little higher than the required rate of return. So alpha is equal to 0.89. You can see here alpha, 3-year alpha is 0.8. So yeah, this calculation actually pretty accurate. So the 3-year return is okay. It's about the same to the benchmark S&P 500. How about 5-year return? 5-year, you get the required rate of return is 19.86. Then greater than 19 point, the real return is 19.32. So the 5-year return actually, the funds didn't perform well. I mean, it's about the same. Alpha give you alpha is selective alpha. Just say 5-year, these funds didn't outperform the benchmark. So it's okay. So this is basically this how you use the CAPM. Then just quickly to compare these funds, see if the funds are outperforming the benchmark. So this is a good way to use that. Okay, so we talk about this security market line. So basically say assets above this security market line, just as we saw before, the previous slides, if the alpha is greater than 0, so that security basically considered is undervalued, so it's good to buy. So if the assets below, the security market line, so which is the security is overvalued, you should sell it. You should not hold it, right? So that's basically given those information. Then say we now have an expression for the required rate of the return, opportunity cost of capital, risk-adjusted discount rate. So basically, in many situations, we are given we have to use the type of this rate. So you can use CAPM for those rate as well. So just a quick say, the components in financial industry say, if the market is greater than the risk-free rate, so basically this is called market. This is called market risk premium. Then you time beta, so this is called this individual stocks or individual securities risk premium. So quickly, just an example, just say I have a ABC 3 mutual funds manager, right? They say suppose the 3 mutual fund manager have the same average return, so their return are the same. Then, however, their beta is different. If they all give you 15% return, but A give you less volatility, less risk, then B is on the line, then give you a higher beta than A. This beta B is supposed to, it's required. C is underperforming. So given this situation, A is above this line, is outperforming. B on the line is just okay. C under the line is underperforming. So we just want to quick compare the market capital line and with this security market line, right? I have another slide, another video is regarding capital market line is the portfolio. So this is a capital market line. They instead use beta. They use the standard deviation, the security and the market. So this is basically say it's efficient portfolio. Usually, the portfolio is not as the ideal as the efficient. So that's why we only use the this CAPM is more realistic. So anyway, so this one you have to know the capital market line have a tangent here. So the tangent portfolio, tangent say portfolio is the market portfolio, so it's the most desirable portfolio. So last, just to remind you to use CAPM. So because there's a beta in it, so you have to make sure your underlying the security have compared to the benchmark, there are R squares has to be greater than 70 in order to use this one. Always check the R square first.